The hardest part about BFCM isn't the marketing, isn't the offer. It's actually how much inventory to buy. For so many brands, it's such an outlier of a time period where you have to basically make a risk-adjusted bet. November's great, Q1's even better with like New Year, Healthier You. So like if you mess up and don't sell enough, you kind of have that fallback. Week 1 of November, even like the last week of October through December is basically like game time.
So, BFCM countdown. We're sitting here at the end of August. What conversations are you having with brands right now from a BFCM perspective?
Yeah, so I think for Black Friday, Cyber Monday, a lot of brands probably have like a pre-set expectation of what they're going to run for the promo itself. Obviously, it can also vary depending on how many BFCMs you've had in the past. If you've not done too many runs at BFCM, you may want to be testing offers in the lead up to see if there's a more optimal offer that you want to run. But a lot of times the offer may not be 100% the same, but it's going to be similar. So whether it's an up to X% off, a straight site-wide discount, a buy more, save more, we have some of our preferences depending on like the niche or the industry or the type of product you're selling. And then I think simultaneously, you're also in a moment here in August where for a lot of brands, depending on lead times, you're making those final BFCM kind of POs. And in some cases, maybe even POs that run into Q1 with Chinese New Year or other things going on. So it's a very fun time. It's kind of the anticipation is building and lots to kind of think about. I think that also Labor Day and like the number of customers you acquire in August, September, October really impact your November, December revenues, both in terms of return customer cohorts. Oftentimes for many brands, the retention rates by cohort for customers acquired in August, September, October timeframe are some of the better of the entire year due to their proximity to BFCM and those comebacks. Oftentimes targets are changing going into it. And then you also just have like the broad awareness that can be created when ad spend is high going into the holiday season. So those are kind of like a few different things we're chatting about, but definitely lots going on right now.
Awesome. And I think there's a few ways we can take the episode, but maybe we can start by... So you and John had a really great episode that you just put out on the demand planning side of things. I think it'd be great to chat demand planning and inventory. Before we jump into things though, Dylan, is it fair to say that different brands of different maturity should have a different approach to how they handle BFCM? You know, you made a comment about how like, if this is sort of one of your first few BFCMs, maybe your approach is a little bit different than if you have more of a mature business. How should brands think about it? Is there like a revenue tier or revenue ranges in which like, if you fall in the 10 to 20 range, or if you fall in the 5 to 10 range, like you're thinking about it slightly differently, or am I oversimplifying it? Does that make sense?
Well, I think that the hardest part about BFCM, from my perspective, for many brands, isn't the marketing, isn't the offer. It's actually how much inventory to buy. And the reason why is because for so many brands, it's such an outlier of a time period where you have to basically make, to some degree, a risk-adjusted bet, but there's still a bet involved. You're still trying to forecast how much you think you're going to sell. And the brands that have been around for longer and have more historical data to go off of will just generally do a better job of doing that. Maybe they have more reps as well in their forecasting. So as a smaller brand, I would definitely think about risk a little bit more. I think you should always be modeling out risk to rewards, but let's say you have like 5 potential scenarios. You have your best scenario all the way down to your worst scenario. Like maybe when you're on the smaller side and when you have less of a balance sheet to kind of manage risk too, maybe you want to plan on the safer side. When talking with brands, we'll often lean towards taking a conservative approach unless the balance sheet is just like ridiculously healthy or you have a specific type of business where in the event that you miss by a lot, the sell-throughs are still expected to be really good in, say, Q1. For example, like a lot of health and wellness products, like November's great, Q1's even better with like New Year, Healthier You. So like if you mess up and don't sell enough, you kind of have that fallback. Or maybe you have a ton of subscription revenue. So if you miss, that comes and helps kind of sell through those units pretty soon thereafter. The riskiest would be like, I'm selling Christmas trees or like something that like generally people only buy in that moment. Do not sell them in that moment. You have to wait a whole year. I guess in the case of Christmas trees, they probably would not make it to the following year. But like you go,
I usually try to buy mine in February. It doesn't really go well ever.
Yeah, you should learn by now, Jacob. But yeah, so I think that's the biggest thing to think about on the inventory planning side is like what type of product are you selling? How much data do you have? And then making a risk-adjusted bet. Like if your bad scenario plays out, you have to have a bad scenario. Maybe it's even worth taking your bad scenario and making it look even a little bit worse, and then considering that your bad scenario, what happens? And are you going to be okay? And then if you're doing that, I think that's generally the responsible thing to do.
I think the health-driven CPG brands actually get like almost a second BFCM with that January effect. It's pretty cool, at least in our experience. Like we typically see like a second pop, which is awesome. It's actually like a built-in inventory clearing mechanism for the brand. So that's actually a really great position to be in as a brand that benefits from that momentum. On the inventory side though, so okay, you made a lot of good points. You talked about how much to buy. You brought up Chinese New Year. You brought up risk. You brought up reward. Let's maybe first define what the risk actually is, and then we can jump into specific strategies around like PO sizing, things like that. But like, what in your mind is the risk? What in your mind is the reward? Is the reward that you can hit like a certain growth comp year over year? Is the reward that you can hit a certain contribution margin target? Is the reward that you basically soak the sponge in Q3 with a lot of customers, to your point, that you're trying to acquire, or subscribers that you're collecting on the opt-in side, and then you're able to essentially monetize those subscribers or that repeat customer behavior in Q4? And then what's risk? Is risk the fact that you just bought too much inventory and have to sit on it longer than you want? Is the risk bigger? I know risk is a spectrum, but like, how do you think about risk? How do you think about reward?
Yeah, so it's the way I would just, there are scenarios where you can buy a lot and have it not be risky, but like for many brands, you're going to have some sort of terms when purchasing inventory. So I'll give you an example. Let's say that you you want to buy $1 million cost of product, and you have to put 25% down, $250K. Let's say you have $350K in cash or whatever, and you put $250K down as your deposit. And then you have, let's say you buy it in August and it arrives first week of October, and you have net 90 after it lands in port if you're buying from overseas. In that scenario, you basically have to pay it at like the end of the year or first week of January or whatever. If you don't sell enough in terms of like to actually yield enough cash to keep after your other expenses to pay for that PO, you may not be able to pay for said PO unless you come up with an alternative financing strategy. Alternatively, if you take out debt capital, whether it's credit line, MCAs, whatever, there might not be enough to also satisfy those obligations. If you use those to finance a PO, you think you can satisfy them because you have an expected sell-through, but then you do not. Theoretically, if you're just sitting on a ton of cash, you pay for everything up front, which is pretty unheard of at scale. Then like worst case, you just sell-through it slower. So like the risk isn't necessarily like catastrophic, but if you're using any sort of leverage, and in some ways net terms are leverage, you then basically do have a scenario where your worst case scenario risk is actually greater than your liquidity can satisfy, and you can get into some pretty bad outcomes. So that is the risk. The reward would probably be, in many cases, just like profit dollars generated, as most D2C brands are trying to optimize for maximizing profit dollars. And then you'd have like your return on invested capital. So you invest in the inventory, and then your ROIC is basically how much profit you get out of those units that you invested into. And that is essentially your return, and trying to maximize in some ways that. In some cases, it's just looking at like contribution profit dollars. When you get into ROIC, it's more like percentage gains. That's a whole other conversation, but you're basically trying to get a yield on your investment into your inventory.
Yeah, that's an interesting framing. I think about it a little bit differently. I mean, that all makes sense along those lines, but I think this is where brands sometimes confuse EBITDA with actual cash flow. Like, I think that sometimes those two things are not understood. For example, let's say you make a really large PO. For instance, you take a lot of working capital, you tie it up into a big PO, and you're selling through that inventory slower than you expected. Well, in your financial model, for example, you might actually have a certain contribution margin profile for the products that you're selling through. You might have an actual profit target that you think you'll hit based on the cost of goods, based on what you think like the discount's going to be, etc. But what if you need to move through that inventory faster because you're literally not getting cash out of the inventory fast enough to meet your other obligations? That's where profitability actually starts to take a hit, because you're actually choking from a cash perspective. Like, you're not getting cash out of the inventory fast enough to cover your other obligations because maybe you had too large a goal in terms of what you expected to sell through. So on paper, if you met your forecast, your profitability would be X. But because now you have to move through the inventory faster just to get the cash out, you're actually willing to take a hit on margin. Maybe you're discounting it more, etc. And you're basically burning through inventory just to get cash back out to either pay the obligation of the PO itself, pay other obligations in terms of fixed overhead for the business. So I actually think sometimes those two things are misunderstood. Like, just because you can model out the unit economics on a profit per sort of like on a gross margin basis doesn't necessarily mean that in terms of the cash you get back out of the actual PO, that you can necessarily always make those two things match up. Is what I'm saying making sense? Because we've seen brands run into that from a solvency perspective.
I think it also depends how you calculate ROIC. So like in A, it's like if you calculate your return on invested capital after fixed expenses, I think that's how you have to do it in those situations. But then you also have like obligations you have to hit too. So it's like if you're financing it in some way, shape, or form, you're still trying to get an ROIC. You're just trying to get an ROIC after you meet those obligations, similar to a fixed cost. In this case, the obligation is probably some sort of like an interest payment or like an MCA or whatever. So I think that like at the end of the day, like e-commerce is essentially a cash flow. It's a cash flow management business. Like if you do $1 million of EBITDA, like are you able to take out 200K as a distribution, 300, 100, 500? Like it really depends. And you basically have to balance that, how liquid your cash flow is that you can actually retain, alongside just in general increasing profits, because you have to basically take a pretty sizable chunk of your profit and roll it forward to buy more inventory to continue sustaining growth, or maybe do like R&D for new products. So it's like cash flow management and execution is like one of the biggest things that people get wrong. And you have to make sure that either you as the operator or a partner or a team member in the business is just like excellent at the management of that exercise, because that's honestly probably the most common thing we see cause issues. And in fairness, it's really hard. These are such cash intensive businesses that when you're planning for a big moment like Q4 and you're trying to figure out how much money do I just like plow back in from my first 3 quarters of profits into the Q4, like it's tough.
Yeah, no, totally. Cool. Well, I highly recommend everyone check out the episode that you and John did on this, because that whole conversation is just really a deep dive into demand planning. I think moving on, we can chat a little bit more about maybe the customer acquisition side, specifically what you're doing in Q3 and what brands should be thinking about going into Q4. So how does Q3 look right now, Dylan? What are brands thinking about? What should brands be thinking about? And yeah, how do you carry Q3's momentum into Q4, or at least use it as a kind of launch pad for making Q4 the biggest the biggest quarter it could possibly be?
Yeah. So, I mean, like most brands have like a monthly contribution margin or EBITDA target, a quarterly and an annual, depending on how flexible those are. A lot of times the way to do it for many brands, not all, is let's say you have like an EBITDA target of 10%, and you're driving that with some contribution margin before fixed cost, or some like profit generated after your variable expenses. In Q3, it might actually make sense to run EBITDA at 7% or 6% or whatever. And the reason why is because if you know that X% are going to come back and buy again in Q4, you're actually potentially going to get more growth rate year over year with hopefully the same annualized EBITDA target to forecast, or whatever what your goal is. So a lot of brands right now in Q3 are kind of pushing hard to acquire customers, especially in this like August 15th to September 15th time window, just because it's kind of that like Labor Day / back to school / like you're selling like colder fall products. Like there's a lot of momentum for a lot of brands during this season, not all, but a lot. And then you kind of roll that into Q4 by coming into Q4 with some really fresh cohorts that have a high probability of being some of your best performing cohorts. So that's part of it. I think October for many brands can be a little bit of a so-so month. So oftentimes you kind of have to like manufacture moments to kind of like make up for the fact that it's a little bit softer. Maybe that's product launches. I think sales are tough in October and promotion, because there's that better sale around the corner that people are most likely thinking about. So we like to kind of lean towards like new and novel from a product launch standpoint in October, when it kind of makes sense based off of what the brand sells. You could also try to do a different type of promotion that's just completely dissimilar to a Black Friday sale. And if there's a unique element to it, maybe it can do well. So October coming out of September, sometimes with a little bit of pullback. And then to us, like week 1 of November, even like the last week of October through December is basically like game time. We are a fan most of the time of running pretty prolonged BFCM sales. We've seen a lot of success when brands run them for like essentially the majority of November and then a good chunk of December. Maybe the offer changes a little bit here and there, especially for newness on like the retention channels. But like this is just like the time of year where like promotions are going to dominate. So we're a fan of getting started early.
Yeah, 100%. I also think that it just gives you more shots at bat from a repeat customer standpoint. Like if you're acquiring a customer at the end of October, for example, through some sort of BFCM offer, or an offer that leads into BFCM or however it's set up, you probably stand to reacquire that customer come BFCM weekend again. Not guaranteed. It obviously depends on what the intrinsic LTV of your business is, but I do think that having a longer sale just gives you more opportunities to convert customers that you acquire early in the sale, and also more opportunities for you to convert net new customers, because it is sort of just like a month-long event at this point. From a consumer perspective, it is just like, cool, the brands
It's
that I'm...
It's basically 2 months. It's basically
2 months, yeah.
You also have like that month 0 cohort retention rate in November is also like a really sneaky one. If you can get a sizable percentage of people in the front half of the month, that's a really good point. Some brands don't carry that momentum from BFCM into early December, but for many brands they do too. And like I think that a lot of people just like pull back on promos in December because we did our big promo in November, and it's like, well, why don't you just do another one? Like,
Yeah.
it's like even in early December, the marketplace is so competitive with offers that if you are not competing, you are just probably going to lose. And lose doesn't necessarily mean like you're going to lose money. It's just like opportunity cost. There was possibly still way more volume to be had if you, ideally that volume is still the profit target you want, as you continued to play the game of the end of Q4 promo period.
I was just going to ask, have you seen this? There's been some, conversations on X, on LinkedIn around that this year shipping cutoff dates for the holidays may actually be pulled forward as a result of some of the warehouse capacity, specifically what's been happening with tariffs, things like that, overstock of inventory, things of that sort. Do you think there's any risk there? Is there anything brands should be thinking about? It's been a topic that's come up, but I don't know how relevant it is to some of the brands that we're working with, but there were some things around, should we expect actually earlier cutoffs? So a more compressed kind of start of December from a volume standpoint, and then a much slower sort of second half? Or do you not think that that's super relevant?
So I mean, like if you're a brand that self-fulfills, and that is true, one could speculate that when other brands are not shipping as much and spending as much as the byproduct, you could have like an arb towards the tail end of the cutoff. I think that's already true in many cases. Like without getting into specifics of like what days you start to see drop off in December, like the brands that can really push it as close as possible to the holidays with their shipping cutoffs, I think that you have an opportunity there. So that still continues. If you are in the brand, if you're a brand where your shipping cutoff all of a sudden moves to, I don't know, December 10th, just start your sales sooner. Like at the end of the day, I think you could even start them at the end of October. Like if you have a target revenue and a target contribution margin dollars, and you think you can do X contribution margin dollars per day, and you need to basically like get enough days in there, maybe the end of October isn't as efficient as the first week of December. But to me, I just don't see the downside of doing that. And there are certainly cases where that downside may exist, but I think more often than not, it probably does not. And then the alternative to that is like, you could also just like compress more spend into fewer days. And that can sometimes work too. The downside of doing that is when you take that to the extreme, there's like incrementality to daily efficiency, where it's like you can physically only get so many dollars into a platform based off of your current offer, creative, etc., at a specific yield. So sometimes it's actually better to prolong instead of compress and increase volume to make up for like the fewer days. So like depending on how big the gap is, if it's a pretty big gap, I just add more days to the promo. And if it's a pretty small gap, you could just potentially compress more spend in just the same number of days or fewer days.
Awesome. Dylan, I think we covered it. I mean, we'll probably need to do a separate episode just to chat through timeline planning, offer strategy. But yeah, I think we got it.
I think this BFCM is going to go well. I'm pretty optimistic, pretty bullish. Yeah, we'll see. You never know. It's hard to kind of estimate these on like a macro level, but I think that a lot of brands are in a really good spot after, in some cases, like a rockier start to the year with tariffs and whatnot. But I'm pretty excited.
Awesome. Same. Well, thanks, Don.